In this lesson, we're going to move into the next step of our merger model, which is to actually combine the income statements of the buyer and seller. So we're going to look at Apple's income statement, which we've laid out right here, and then Research in Motion's income statement, which we have linked in right here, and we're actually going to combine both of these and see what the exact impacts of using cash versus debt versus stock are in an acquisition like this. So you see down here that I've created this area for combined income statement, and most of this is going to be extremely straightforward. There's absolutely nothing complicated about combining the income statements of two companies, and literally all you do is for revenue, for example, you go to Apple's 2010 revenue right here, then you add RIM's 2010 revenue right here, and that is your combined revenue. So literally all you do for this exercise is go through and just add up all the individual line items here. Now when it gets to items like gross profit and operating income, when you actually make calculations, it's better to actually make the calculations on the combined income statement right here as opposed to linking in from elsewhere. The reason being that if later on we somehow change these calculations or add in new items, they're all flowing in from this combined income statement. So in general, for revenue, cost of goods sold, depreciation, amortization, stock-based comp, interest income, those items you can link in and add directly from Apple and RIM's income statements. For the other ones though, so gross profit, operating income, income tax provision, net income, for example, all of those you should be calculating here. Now this process of combining the income statements is actually so simple that it's going to be your exercise. So what I want you to do is go through and start with combined revenue and go all the way down to interest income and expense right here. Now once you have all those combined, we're going to get started with looking at the acquisition effects, which I've highlighted here: foregone interest on cash, interest paid on debt, and diluted shares outstanding. And those will require some explanation, but the first part of this is very straightforward. So right now you should pause this video and try to combine the first part of the combined income statement yourself, going from revenue down to interest, income, and expense. Once you're done, you can unpause this video and then we'll go through the exercise together. So pause this video right now and try to combine the first part of the income statement. Okay, good. So here's what we should do to create this combined income statement. So for cost of goods sold, once again, we're going to link up to Apple's cost of goods sold for 2010 and then add RIM's cost of goods sold. For gross profit here, we can just take revenue minus cost of goods sold. For operating expenses, we can go and link and add Apple's operating expenses to RIM's operating expenses for 2010. For depreciation, amortization, and stock-based comp, the same strategy applies. We can go up and link and add Apple's numbers to RIM's numbers right over here. Copy this down with Alt-ESF. Now for operating income, we're going to make the calculation right here, and we'll say gross profit minus operating expenses minus depreciation minus amortization minus stock-based comp. For interest, income, and expense, we're going to link directly and just add up these numbers. So Apple's interest, income, and expense, and then RIM's right over here. And so we have all that in place. With all this set up now, we can just copy everything here with Shift Control down arrow key, Control C, and then Alt ESF to paste it for 2011. And we can see that going through this, all these numbers are correctly linked now. So we have the first part of our income statement, our combined income statement, set up here. Now the next segment of this will require some more explanation, so we're going to move out of exercise mode for this. So the first two effects here, foregone interest on cash and interest paid on debt. So foregone interest rate on cash, what we're really saying here is that our interest income is going to go down because we're using cash to pay for this company, so our interest income is going to go down. But I've chosen to indicate it on a separate line here just to be clear about what's a result of the acquisition versus what is the company's existing interest income. So to make this calculation, all we do is go up here we take the cash used for the $14 billion number, and we multiply by our cash interest rate of 1%. So it comes out to 143 million. And that's literally all you do to figure out how much interest you're losing as a result of not having cash or not having as much cash on your balance sheet. Now, we should also turn this into a negative because anything here that's an expense is listed with a negative sign. We also want to anchor both numbers with F4 so that they don't shift around when we copy them. But we can actually just copy this as is to 2011 with Alt ESF. Now, this is not 100% accurate because as a result of losing this 143 million in interest, we are going to actually be losing more in foregone interest in 2011, but we're not going to worry about that kind of detail. This is very close, and for numbers this small, it doesn't make a difference or that much of a difference anyway. For the interest paid on new debt, the same strategy applies. We're going to use a negative sign and go up and take our debt issued, anchor it with F4, and then multiply it by our debt interest rate of 9% right here. Anchor that with F4 as well. So we see that as expected, the interest paid on debt is significantly higher than the interest lost on cash because 9% is much bigger than 1%. Just copy that over. And so this is really telling us the impact from using cash versus debt to pay for a company. You can probably already tell from this, but in most cases, all else being equal, a company will almost always prefer to pay with cash because the interest rate on cash is much lower than the interest rate on any type of debt. And you can see the math illustrated very clearly here. We're using the same amount of cash and the same amount of debt, but the interest, the impact on our financials is completely different. Now for the pre-tax income, we're going to take operating income here and then simply add each of these line items. And what we're really saying is we're subtracting the foregone interest on cash and the interest paid on new debt. For the income tax provision, so we're going to take pre-tax income and multiply by Apple's tax rate right here. Do not make the mistake of using RIM's tax rate. In a merger model, when you combine the companies, you always use the buyer's tax rate because the buyer is acquiring the company and everything is going to be taxed according to the buyer's tax rules. We'll anchor the tax rate calculation right there. For the net income, we're going to take pre-tax income and then subtract the income tax provision. Now for earnings per share, so what we want to do here is take our diluted shares outstanding and then add the number of new shares that are created in this transaction. So let's go up and take Apple's existing diluted share count, so 907 million right here. And now we're going to add the 74 million new shares that were created as a result of this transaction. I'm going to also anchor that with F4. So we see now we have closer to 1 billion worth of diluted shares outstanding. Now with interest and debt, it's very easy to tell at a glance what the impact of both of those is because it's a number. With diluted shares outstanding, by contrast, it's much harder to tell at a glance what is going to be the impact on net income versus foregone interest on cash and interest paid on debt. So it's much harder to tell at a glance what's going on here. That's not really an issue though, because most of the time in interview situations and any time that you have to think about this, they usually give you much better numbers than what we're seeing here. So now to calculate earnings per share for the combined company, we're going to take net income, multiply by units, and then divide by diluted shares outstanding. So it comes out to 1251 right here, which is actually quite a bit higher than the 1159 that we had before. So now that we have this in place, all we're going to do is copy these over with Control-C and then Alt-ESF. And I'm just pressing F2 to go through all these. Make sure they're all linked correctly. It looks like that's the case. Looks like everything here is anchored correctly. And so that's all we really have to do to combine the income statements of Apple and RIM, to combine the income statements of a buyer and seller in a merger model. We simply combine items like revenue, cost of goods sold, operating expenses to get to our operating income. we add together the existing interest income, then we factor in foregone interest on cash, interest paid on debt to get to our new pre-tax income number. We apply the buyer's tax rate to get to our net income. And then to get to earnings per share, we take our old share count for the buyer, and then we add the number of new shares created in the transaction. And then we use that to get to earnings per share. So that's all we really have to do for combining the income statement of the buyer and seller here. The only tricky part is to remember that when you're taking diluted shares outstanding here, you're not adding RIM's diluted shares outstanding because these are all being destroyed in the transaction. When you buy a company, you're effectively getting rid of all of its shares. It no longer exists as a standalone entity, so all of its shares go away. So in a merger model, do not make the mistake of combining the buyer and seller's diluted shares outstanding. What you should be doing is taking the buyer's diluted shares outstanding and adding in the number of new shares created in the transaction. So that's really the only tricky part with combining the income statements here. So with all that in place, the next thing we want to do is see what the actual impact is. So we're going to look at the accretion dilution. In other words, how this 1251 and 1489 right here, how these numbers compare to the 1159 and 1359. What can we say about the percentages? What can we say about the increase or decrease? And what is it really telling us about the financials of this deal and the feasibility and the chances of it actually happening?